you do, whatever area that you get into, given that even if you're the best, there's always a chance of failure.
What if China's massive debt crisis is the ticking time bomb threatening the global economy? Imagine the ripple effects on your investments, your savings, and even your job. Don't miss out on understanding how China's debt dilemma could shape the future. Stay ahead, stay informed. A ticking time bomb. The global debt crisis is becoming a real concern for economists and policymakers alike. As of 2025, total global debt has soared to an unprecedented $300 trillion. This alarming figure raises the question: is the world on the brink of a financial collapse? Governments and businesses worldwide are heavily borrowing to fund their activities, but many are struggling to manage their obligations. The International Monetary Fund, IMF, has warned that excessive debt accumulation could lead to an economic meltdown, especially if growth slows down. For countries like Japan and Italy, their debt-to-GDP ratios are dangerously high, reaching 250% and 150%, respectively. Meanwhile, emerging markets, especially in Africa and Latin America, are facing their own debt crisis, with rising inflation and interest rates making it harder to service their loans. The question remains, can these nations manage their debt burdens without triggering a global economic disaster? The coming years will be crucial in determining whether these escalating debts will prove to be a ticking time bomb, or if they can be diffused through smart economic policies and international cooperation. Economic indicators point south. Recent economic data paints a worrying picture for the global economy. Key indicators such as slowing GDP growth, rising unemployment, and an increasing risk of inflation suggest that we may be on the cusp of a global recession. The World Bank and other financial institutions have repeatedly downgraded their growth forecasts for the coming years, with predictions pointing to stagnation or even contraction in some major economies. In particular, advanced economies like the US and EU are struggling with sluggish growth, even as they face inflationary pressures from global supply chain disruptions and geopolitical tensions. Meanwhile, many developing economies are grappling with the double burden of high debt levels and underperformance in their key sectors, such as agriculture and manufacturing. Countries that are heavily reliant on exports are feeling the squeeze as global demand for goods and services weakens. The International Labor Organization, ILO, has raised concerns over the rising unemployment rates, particularly in youth unemployment globally, which remains at critically high levels. If these trends continue, it could be a precursor to an economic downturn that affects every corner of the world. The possibility of a global recession hinges on whether governments and central banks can respond effectively to mitigate these risks, using tools like fiscal stimulus, interest rate adjustments, and international trade cooperation. However, with mounting debt and weakening consumer confidence, the road ahead looks increasingly uncertain. Are businesses overleveraged? In recent years, the level of corporate debt has skyrocketed, with companies borrowing extensively to fund operations, expansion, and stock buybacks. As of 2025, corporate debt in major economies such as the US and China has reached alarming levels, raising concerns about whether these businesses are overleveraged. High levels of debt leave companies vulnerable to external shocks, such as an economic slowdown, rising interest rates, or disruptions in global trade. Many corporations have taken advantage of low interest rates in the past decade to issue cheap debt. But now, with interest rates rising in response to inflation concerns, servicing this debt is becoming more expensive. Companies with high debt-to-equity ratios are particularly at risk, as they may struggle to meet their obligations if their revenues falter or the economy slows down. The risks associated with corporate debt are not limited to individual companies. They could lead to a systemic financial crisis. A wave of defaults in the corporate sector could ripple through the economy, affecting everything from employment to stock markets. Additionally, these defaults could undermine confidence in the financial system, leading to tighter credit conditions and further economic contraction. Experts warn that businesses must manage their debt more cautiously moving forward, focusing on sustainable growth rather than relying on borrowed capital. The upcoming years will test whether corporations can weather rising debt costs without triggering a broader financial crisis. The plight of developing nations. Developing nations are facing a growing debt crisis that could have dire consequences for their economies and the global financial system. Sovereign debt levels in many emerging markets have surged in recent years, fueled by external borrowing to fund infrastructure projects, social programs, and government spending. However, as interest rates rise globally and economic growth stagnates, these nations are struggling to service their mounting debt. Countries in Africa, Asia, and Latin America are particularly vulnerable. In 2025, many developing nations are spending more on debt repayments than on critical investments like education, healthcare, and infrastructure. Nations like Sri Lanka, Zambia, and Greece have already defaulted on or restructured their debts, with many more at risk of following suit. The situation is compounded by inflationary pressures and currency devaluation, which make it harder for these nations to repay their debts in foreign currencies. As debt payments consume a larger share of national budgets, governments are left with little room to stimulate growth or protect vulnerable populations. In extreme cases, this can lead to social unrest, political instability, and migration crises. International organizations like the IMF and World Bank have proposed debt relief initiatives, but these efforts have often been slow and insufficient to prevent defaults. The global community will need to find more effective solutions to prevent a wave of sovereign defaults from triggering a broader financial crisis that could affect not only developing countries, but also the global economy. From property sector woes to national concerns, China's debt crisis has been a growing concern for years, especially in the real estate sector. In 2021, major developers like Evergrande began facing massive debt defaults, threatening to trigger a nationwide financial disaster. By 2023, China's property market was dealing with over $5 trillion in debt. This issue has spilled into the broader economy, affecting everything from consumer spending to global supply chains. With the government implementing measures to stabilize the market, China's debt dilemma remains one of the most significant challenges to global financial stability in the years ahead. Central Banks Balancing Act. In 2025, central banks face a tough challenge. With debt levels soaring globally, they must carefully manage interest rates. The world is watching as inflation surges and economic growth slows down. The Federal Reserve and European Central Bank are walking a tightrope. If they raise rates too much, it could choke growth. If they don't act fast enough, inflation could spiral out of control. These decisions impact everything, from mortgage rates to the price of everyday goods. As governments and businesses struggle with rising debt, the actions of central banks could either prevent or trigger a global financial crisis. Striking the right balance. In recent years, the global economy has faced a challenging dilemma: how to balance debt sustainability with economic growth. 2023 saw record-breaking global debt levels, with total debt surpassing $300 trillion. Governments and businesses alike have borrowed heavily, hoping to stimulate growth. However, the risks are high. If debt grows faster than economic output, it can lead to financial instability. Central banks, like the Federal Reserve, have been forced to raise interest rates in 2024, making borrowing more expensive. The key now is finding a balance between investing in growth and keeping debt levels manageable to avoid a crisis. Don't let the next global financial crisis catch you off guard. In our next video, we dive into trade wars. Do tariffs actually protect domestic industries? You won't want to miss it. Hit that subscribe button now and stay on top of the world's biggest economic shifts. Your future self will thank you.